our problems. Okay.
2036. This kid that I'm having.
All right. So let me share my screen with you. We'll be over here in Module 5. And so, can you see my screen okay?
Yep.
Yes.
Okay,
Yes.
perfect. All right. So, first things first, the midterm. I am still working on grading those. Hoping to have all of them done by probably either Wednesday or Thursday. So I am working to grade those. There is going to be an opportunity for extra credit. So I don't think you two have either one of you have had me before, right?
No, ma'am.
Okay.
No, ma'am.
I didn't think so. So opportunity for extra credit, it works like this. Basically what you do is you go in to your exam and you're going to take a look at all of the problems that you missed. Okay, so all of the things that you potentially got wrong, right? And you're going to review them, and the answers are in the exam itself. So you can see what, the answer key looks like and things like that. And you can follow what you should have done in order to get the answers. Then what I want you to do, in order to get half of your points back that you missed, so let's say one of the questions was worth 20 points, you only got 10 awarded, you can get back 5 points to increase your score. Okay? So what you have to do is you have to go in, create an Excel document that basically takes and tells me what you did wrong, why what your thought process was, the reason why you did it wrong, and then tell me exactly how to do it correctly using the answer as the guide and what the correct steps are. The reason I do this, and it always works out very nicely for everybody, is because as we talked about in the very beginning of the class, accounting builds upon itself. So by the time you get to the end of the class, you're going to wind up actually learning more if you go in and you correct that midterm than if you were to have not done that. Okay, and the final exam is going to be a little bit easier because you'll have realized, you know what, this is what I was doing wrong. I was overthinking it. I wasn't following the steps properly. Here are the steps that I needed to follow, things like that. So one of the things that I do this in every single class I teach. One of the things that I always get a tremendous amount of positive feedback on is this very exercise. And yes, it's work. Yes, it's extra work. It's extra credit, and it helps you bring up your grade. Okay, so this is your extra credit opportunity. All right, so it's also extra work for me to then go back through and make sure and review and make sure that you thoroughly understood it, you've got the concept, we're good to go moving forward, right? So, so that's what I want you guys to do as for your extra credit. Okay, make sense?
Yes, ma'am.
Sound like a plan? And then it will be due. I will give you until, let's see, if I'm finished grading by Thursday, I'll give you until the following Thursday night, so the same night that your homework is due, your midterm corrections for your extra credit is due. Okay?
Okay.
That'll give you that weekend to work on it.
So so you want us to, when we do our corrections, just go back and do you want us to highlight like what you said, where we missed, highlight the corrections on that? So do you want both the old answer and the new answer?
You don't have to put your old answer in there necessarily. You just have to tell me what you did wrong and why you did that. So analyze yourself,
Okay,
basically.
gotcha.
Okay.
Analyze what happened. Analyze, did I just simply miss a number, or did I potentially miss the entire process? Was there a step out of process, right? So that's what I encourage you to look at, is to really analyze what you did wrong. Okay. So that's what I want you to do with those midterm corrections. All right.
Okay.
Gotcha.
Okay. All right. All right. Hello, Jackie. Okay. All right. So then moving on, were there any questions or anything like that from last week? Anything that you needed help with, or anything from the Module 4 assignment? Everybody good on that?
Please talk to Andre. That's my son.
Nope. Good? Okay. All right. So Module 5, this was covering Chapter 6. And I'm going to go ahead and go into our Chapter 6 book. And we will, okay, take a look at Chapter 6. Okay. So basically, Chapter 6 is a lot about cost behavior analysis. Okay. So that sounds like something really scary. It's really not. So you're basically just doing cost volume profit analysis. Okay. So your cost behavior analysis is basically about selecting your activity base, doing your graphs, classifying your cost behavior patterns, taking a look at relevant ranges, analyzing the cost behavior via these methods. And you'll see, each method is just slightly different. Okay. One of your problems is focusing on the high-low method. And that's going to be important for you to understand. But each one of these methods is a little bit different in their process. So again, this is all about process. We're not really doing anything super complicated other than addition, subtraction, multiplication, division, but it's about the process. So you have to really think about the steps that you're taking in order to get each of your answers. Okay. So one of the things that the problems in these two, in this chapter in particular, do well is walking you down through the process that you need to make sure you understand. So pay attention to the order that they're asking these questions. So when it's like you have a question that has 6A, 6B, 6C, 6D, that's because you have to solve A before you can solve B, C, or D, right? So, just keep that in mind, and as you're working this, keep those thoughts, in your head, is there is a process to this, and it's just like every other chapter we've covered, very process oriented. Okay. So then when you're looking at your analysis, you're doing break-even analysis, contribution margin analysis. And why is this important? Nobody wants to lose money on anything, including manufacturing companies. Okay, so what is it going to take for me to break even on this project, right? I need to know how to figure that out, and cost is a huge part of that. That's why we spend an entire class basically talking about managerial accounting and costs and things of that nature. Cost, you have to analyze, and you have to understand that it's a constantly moving bar. In any operation, your costs are always going to change. Okay, it doesn't matter if you're a manufacturing company, if you're a software as a service company, also known as SaaS. It doesn't matter if you're a marketing company, if you're, um, you know, like an accounting company, CPA firms. You're always going to have cost because you always have people involved in these processes. So that is a cost, right? So then you want to take a look at your contribution margin analysis. How much did I really make off of this, right? After all the costs are taken out and all the expenses are taken out, what's my contribution margin? What does that look like? Okay. And then planning for profit. So basically, what companies do is they kind of sometimes work their way backwards. Okay. So they'll figure out here's what our costs are, right? And costs on the income statement, as you know, are down, below revenue, right? Sometimes it's beneficial for you to do an analysis looking at your costs to determine what your revenue needs to be in order to make the appropriate contribution margin. Okay, so there's a lot of figuring out the puzzle. What are the pieces to the puzzle? How do I put this together? Do I need, because not every company is just going to say, I've got to grow by 20% year over year. Some companies do that. Other companies want to say, no, you know what? I got to grow by more than 20%. The effective ones will, because they'll say, it's possible that my cost is increasing by 20% next year. So where does that put me? I've got to take a look at, how does that relate to my revenue stream? Am I going to be keeping up with the cost game or not? Right? So that's kind of what this chapter is about, is, really learning how to analyze that and looking at, like your cost behavior. Okay. It's basically how specific costs are going to respond to changes in volume of business activity. Okay. Because whether or not you may realize it, I'll tell you this for a fact because I've worked with so many different companies and I set the systems up that actually do this. If I were to go into one of my systems, into NetSuite, into any one of my customers, I can give quantity price breaks. Okay. Meaning, if you buy one of something from me, you're not going to get a quantity price break. But if you buy 20 of something from me, I might give you $1 off. If you buy 50 of something from me, I might give you $2 off per item. Well, 50 times 2 is now $100 you just saved. And when you start thinking about over the course of things, we're talking small numbers here. Many things are going to be much larger, in volume and in price. But when you start talking about quantity price breaks and things of that nature, you can save some significant money by, ordering a little bit more or ordering things in bulk, right? And ordering things that you're going to go through. Like say a manufacturer is manufacturing something that takes 100 screws. Well, I might want to buy, if I'm putting out 500 of those a month, I'm going to want to buy those screws in bulk, right? Because it's going to save me a lot of money. So those are just things that they're going to really analyze and want to make sure that they're responding to efficiently, because as their costs go up, so if for some reason, like in the construction industry, this is extremely true, construction costs are changing constantly. And based on seasonality of products, product availability, seasonality of the industry itself. So, it's pretty hard for you to build a house in the wintertime when there's, 2 feet of snow coming down, right? So, volumes go down at that time, prices go up, because that's just the way it is. When there's a lot of demand for stuff, you might be able to keep your prices down a little bit more because people are actually, manufacturing at a larger rate. So, things can fluctuate, right? So there's different cost considerations at that time. Okay. So some costs will increase proportionately as volume increases. Some costs will change disproportionately. Some, it doesn't matter, right? So look at the pharmaceutical industry. Those costs can change, exponentially in a day. Let's take, for example, the EpiPen producer guy that was all over the news. I can't remember his name at this time, but when you increase a product that's absolutely necessary to sustain human life, for those that are allergic to something, and you increase the price by 735%, not dollars, percent, that's a huge problem, and it's impossible to predict, right? So people have the right and the ability to do that. Yeah, they might price themselves out of business, but at the same time, I I can't emphasize enough that you've got to understand your cost activity. So that's what this chapter is teaching you, is understanding your cost activity. Okay. Does that make sense so far?
Yes.
Yes.
Okay. What questions do you have so far? Anything? Nope. Okay. All right. So this is a graphical representation of cost volume relationships. So, obviously the more you buy, the more your cost is going to go up, right? So that's kind of common sense, but it could go up less, right? So you could have a line that goes straight up, because maybe there's no discount in buying more, right? You could have a line that goes straight across. So you have to really look at that. That's what this is more about, right? So you can see here, these illustrations kind of show you the relationships that you can take away from the data. Okay. You also have variable cost behavior patterns. Okay. Those change proportionately with changes in volume of activity. Okay. So, for example, down here it shows you this cost of a water bottle cage is a variable cost in producing either a road or mountain bike. Okay. So this takes into account purely a variable cost pattern, which always passes through the origin. Okay, because zero cost is associated with zero volume. Okay, so this kind of explains, how that slope is created. Fixed costs, as you can see with anything, don't change. You can, so say a fixed cost, let's say your rent. You can be in that house or be in that building using it every day, 24 hours a day, 7 days a week. Or you could be in that building, 8 hours a day, 5 days a week. Doesn't matter. Your rent's not going to change, right? So those are considerations to take in. Mixed costs, sometimes also called, and this is important, semi-variable costs. So mixed costs, and that's typically what we refer to them as in the accounting industry. I will tell you that it's usually mixed costs. Semi-variable is not something I've heard a lot of in all of my years. Okay, so the mixed costs are described as having both fixed and variable components. Okay, so they will respond to volume changes, but a little bit less proportionately because you've got that fixed component in there. So anytime you add that in, it's going to change it just a little bit, okay? So you've got your fixed, you can see here in this illustration, the fixed cost, and then you've got your variable cost as well. Okay, so this is the mixed cost behavior pattern. Then you've got your relevant range, which is the range of activity over which the behavior of the cost behaves consistently. Okay, so, and that's an important term right there. That's important to understand that it behaves over a period of time consistently. Okay, so make sure that you really understand that. Okay. So relevant ranges. Here's illustrations of two different relevant ranges. So water bottle cages step cost and water bottle cages linear cost. Sorry, that's a hard one to spit out. So this is taking a look at the stepped cost, right? And here's our relevant range. Okay, because this is where we find the most consistency in that cost, right? And then here's the curvilinear cost, right? And again, we see our relevant range because here's where we see the most consistency. We got a big spike right there, and we've got a little dip down here, right? But this is really where we see the most consistent change, okay? So analyzing your cost behavior, there's a couple of ways to do that. We can do the scatter graph method, which is basically just taking a look at the cost and the number of water bottle cages, okay? And we create on the scatter graph, we create the cost. So here's $27,000 at $44,000, right? And then here's the 29. Yeah, go ahead.
Is that number of cages produced
Yes.
at that cost? Okay,
Yes.
gotcha.
Yes. Okay. So at 29.5, we produced 48,000. So here's another line or another dot. Okay. At 30,000, we produced 51,000. So here's that. Okay. And then here's the next one, the next one, next one, and these two. So you can see, you know, if we take a look at this and this 4,500 that we're comparing to, okay, the 4,500 is the fixed portion. So likely the fixed portion here, this 4,500, is probably the rent. Okay, so you can see here's that line. But then we come here and we start at the 4,500 and we're going to draw a line right between the middle of these where we see that happening. Okay, so you can kind of see exactly what's happening here. Okay, and that's the scatter graph method. That's literally all there is to it. Okay, once you're taking a look at that on the scatter graph chart, okay, so to determine the appropriate formula for the total cost line, you're going to take and subtract 4,500 fixed cost from the total 27,000 cost at 44,000, okay, to get that 22,500. Then you can take and get the rate of variations, okay, by taking that 22,500 away from, you know, which was our calculation there, and dividing it by the number that we manufactured. Okay, so when you take that, you get 51 cents per water bottle cage. Okay, so you would describe this mixed cost as 4,500 fixed cost plus 51 cents per water bottle cage of variable cost. Okay, and that's what the scatter graph method allows you to do. So it's pretty simple. Do you guys all understand that?
Are we saying that it costs $4,500 to produce one cage? Is
No,
that where the 4,500
no.
comes in?
The
I guess I'm
40,
not saying
the
4,500.
4,500 is the fixed portion of total cost. So this is likely something like your rent. Okay, so you've got to have a place to produce these, right?
Something that's fixed across the
Yeah.
board, no matter how
Fixed
it,
across the
no matter.
board will never change.
Okay, gotcha.
Okay, so you determine your fixed cost, and then you determine, what your rate is per water bottle cage or per whatever you're producing. It could be a widget, right? One of our favorite terms in accounting, a widget. So per widget, per water bottle cage, per, piece of sheetrock, per, Apple iPad, whatever the case may be, it's you're figuring out that rate times the volume. So basically all we're figuring out here is what it takes to produce that water bottle cage in this example. Make sense?
Yes.
Yep, gotcha.
Okay. All right. So then we're going to jump down to the high-low method. And this is one that you want to pay attention to because we are actually doing this in problem 6.4a. Okay. Problem 6.4a is actually one that has you compute the entire method itself. Okay. So the high-low method, again, you're going to take the it's a relatively simple method that basically is just going to compare costs at the highest and the lowest levels of activity for which it represents cost data are available. So basically your highest level, your lowest level. So you're going to plot those out. So basically it's taking the same graph, these same numbers, right? And it's going to take a look at your production. Okay. So you have the line drawn between the highest and lowest points, just like in Exhibit 6-A down here. Okay. Your variable activity unit here per water bottle cage is determined by dividing the difference in the costs at those two levels by the difference in the activity. Okay. So difference in costs by the difference in activity. So you've got two steps there that you're going to have to figure out. So you've got to figure the fixed element of the cost, and you've got to figure out the variable element of the cost. Okay, so the fixed cost is then isolated by multiplying the variable cost per unit by either the top or the bottom level of activity, and then subtracting the resulting product from the total cost at the selected activity level. So in this example, same one that we've been working with, same numbers, okay? We're going to use the lowest and the highest levels of activity. So we've got 44,000, 66,000. That's coming from right here, okay? Those are our highest and our lowest levels of activity. Make sense so far?
Yes.
Okay. Respectively. And then we're going to follow our total cost levels. So you have to figure out, here's our level of activity, here's our total cost. Those again are coming from the charts, okay? And we're taking the difference, so we're subtracting these two out. So you take that 66,000 and that 44,000, subtract them, you get a 22,000 increase in activity, okay? Here, same thing, 38,000, 27,000, you get an $11,000 increase in cost. Okay? Good so far? Then all you
Yes.
have to do is take those differences and divide them out. And it's going to give you 11,000 divided by 22,000. So you take the cost divided by the level of activity to get 50 cents per water bottle cage. Make sense? So far?
Yes.
Okay. All right. Then the next step is to subtract the variable portion from the total mixed cost at the high and low activity levels to give us the fixed portion of total cost as follows. Okay, so this is where we're going to figure that piece out. So step 1, do this. Step 2, do this. Okay, so here we go. We've got our high level, or our low volume level mixed cost, and our high volume level total mixed cost. So pay attention to these, okay? So you've got your total mixed cost, all right? We got that from above, okay? The 27 and the 38, less the variable portions. So now we have to take this 50 cents per bottle and multiply it by our 2 levels. So our lowest level is 44,000. We're multiplying that by 50 cents. That gives us the 22,000 right here under our low. Under our high, same thing. We're taking the 50 cents multiplied by the 66,000 and getting our high level. Okay? So when we subtract these two out, the 27 minus the 22, we get $5,000. When we subtract these two out, ironically, we also get $5,000. So our fixed portion of total cost is $5,000 in this case. Okay?
Okay.
So our fixed portion is $5,000. Our variable portion is 50 cents per water bottle cage, which can then be formulated as follows. So basically what you're looking for here is to get this formula. It's not about just getting a single answer. It's about also creating this formula. So our total cost equals 5,000 plus 50 cents times the number of water bottle cages. So now anytime we need to figure out our cost relationship here using this method, we can use this exact formula. So we can sit there and play with our volumes and predict out our volumes. Say I wanted to figure out how much this was at 70,000. Okay, I'll take my 5,000 fixed plus 50 cents times the 70,000. Make sense?
Yes.
It's all about being able to predict. Okay? So you can then say, you know, that you understand how to do that mixed method. Or, I'm sorry, the high-low volume method. Okay? So this right here is just another practice run at that. Okay? Is to take your highs and your lows. Okay? You're going to plot it. You know, you'd start out by plotting it right here. Then you would do this. Then you would do this. Those are your 3 steps to this problem. Okay? Make sense?
Yes.
Okay. All right. You've also got the least squares regression method. Okay? So the least squares regression method is basically a statistical tool that uses all the data points to separate a mixed cost into its variable and fixed components. Okay? There's standards of error, things like that. Okay? So basically here we're taking the total cost and comparing the water bottle cages again, and we're looking at our data points, which are graphed out here along the line, right? And so sorry, I'm getting blown up in work messages right now. Like, you guys, it's past time. Anyway, so the fixed and the variable costs, the formulas that are used to compute are fairly complex and basically beyond the scope of this text. If you wanted to figure out how to do the least squares regression method, you would likely use an Excel tool. There's actually in Excel, if we looked at, and don't pay no attention to my complex spreadsheets, there's actually in here in formulas, you can use functions, right? And do statistical lookups, financial lookups, just different things. So there are ways for you to figure this out using tools like Excel. Okay, so we're not going to cover that one. And then you've got the accounting costs and practice. So basically that's just kind of showing you, how this can get applied. Okay. And then further down, you're going to be doing the cost, volume, profit analysis, right? So in that, you're going to be working, to find the break-even point. So the first part of any CVP analysis, cost, volume, profit analysis, is to find that break-even point. Okay, so you can say, after you've gone through and you've figured out your costs via one of those first two methods, okay, typically it's based on your high-low method, right? After you've figured out your cost, you can come down here and calculate because you've got everything broken out, right? So this is showing you a different calculation of Fazari 4A CR1 operating income. Okay, so they sold 3,000 units at $1,500 a unit. That resulted in 4.5 million in sales, right? Then they have their costs, right? Their fixed cost is always 595,000, and it costs them $1,138 per unit to manufacture. So you're going to, here's the 3,000 units. That gives you your total variable cost. So it's just separating out those variable and those fixed costs, adding them together. My total cost then is $4,009,000. When you subtract that from your sales, your net operating income is $491,000. Okay, so that's what companies are looking to figure out. What's my break-even point, right? So the cost, volume, profit chart, right, is taking a look at those volumes, right? So here we go. Here's what this looks like, the chart itself. So you've got your total revenue and you've got your total cost. And you can see that these two cross, right? And that's our break-even point. Okay, so the reason the companies want to figure this out is like, okay, where do I have to get in order not to lose money, right? Because this break-even point means I've lost zero. So what's my goal? It's to exceed this point. Otherwise, I've lost money. Because you can see here, your cost is greater than your revenue. You see that? Because your revenue is always going to start at zero. Okay? Your costs are always going to start somewhere. Right? So this is what you call your loss area. This is what you call your profit area. Is this making sense as to how you're calculating that? How you're getting that? And why? Who's lost? Anybody? Okay, I'm going to keep going. Okay. So the basic assumptions of break-even analysis are this. Total fixed costs and total variable costs per unit are constant over the entire range of analysis. Selling prices per unit remain the same regardless of volume in sales. And when more than one product is involved and sales volume varies, each product's percentage of total sales, i.e. the sales mix, that's what this is referred to as, does not change. So basically, this is only useful for a given point in time. Okay? It's one of those convenient tools that people can kind of use as a guesstimate. There is nothing 100% accurate about this because things change constantly. Okay? So you have to be very careful using this to limit it to only a certain point in time. Does that make sense?
So why can't we just use a WAG?
You can.
Same thing, right?
Yeah, you can. Absolutely can.
Okay, gotcha. That's what we do in the government all the time. We just
Mm-hmm.
use wild ass guesses all the time. So.
Mm-hmm. Yeah, but some of those are not completely accurate either. In fact, many of them are not. So, have you guys ever heard of you know how companies go through these huge budgeting, and even the government goes through this huge budgeting exercise every year towards the end of the year, right, for the upcoming year?
Yeah.
Who wants to tell me how accurate and how long those budgets are typically good for in the coming year? Meaning how many months in?
Well, for on the government side, it depends on your program, but usually it's not very long.
You're lucky if you get to March. Typically, budgets are blown within the first 3 months of the year. And that's pretty true for every company I've ever worked for. You know why? Because our global economy and things are changing, technology changes, everything changes so fast these days. Literally, stuff could be changed tomorrow. And it could have a major impact on any given company at any given time. So budgets get blown very quickly because you have all kinds of variables. You have employees, they come and go, right? And that's never going to change. There are some things that are certain, and that's that things are always going to change. So a lot of times budgets, WAGs as you guys call them, even those guesses are no good, a month, 2 months, 3 months down the road. However, we still have to do it because you're typically, if you're really, really good at budgeting and predictive forecasting, you can take what's happened over the past 2 to 3 years, and I don't suggest ever going back further than that because everything has changed so much from 5 years ago. And it's always going to be that way. You're always going to look back and say, oh, nothing is the same as what it was 5 years ago. So 2 to 3 years from now, I 100% can guarantee you, if you can take a look at your past 2 years of financials and kind of get a relatively accurate forecast of what's going to happen, then that's, probably the best guess. That's going to be your WAG, right? And one thing that a lot of companies do today, because of this very phenomenon that happens, is they will actually do forecasts throughout the year. So yes, they'll budget and they'll hope that they're pretty close to their budget. But a lot of times companies wind up going off of quarterly forecasts that, are done for Q2, 3, and 4. Okay. And that's pretty standard for every company I've worked for. Okay. So here's how you're doing your break even. Okay. That's the selling price per unit times the number of units equals the variable cost per unit times the number of units plus the total fixed costs. So that is your break even formula right there. That's the formula that you come back to. Once you get each one of these numbers, you plug them in, you find your formula. Okay. So if your break-even sales is 1,500, why? Here we go with algebra, guys. So you don't know what the number of units is going to be. Okay, so 1500y equals 1138y plus 595. Now we can solve that, right? So we move our y on this side over here, just like we did in algebra, and we get 1500y minus 1138y equals 595. So 332y equals 595. Solve for y, you're going to get 1644 units rounded, of course, to the nearest unit. So that means that 1500 times 1644, your break even is 2,466,000. Make sense how to get that?
Yeah.
Pretty straightforward. Okay. So if we look at that and we plug that in now to get that break even calculation, we're going to say 1644 units. We want to break even at 1500. That gives us our 2,466,000. Our variable cost is the same thing, getting that 1644 times the 1138 to give us 1.8 million. So our contribution margin is 595,128. Our fixed cost is 595. You can see our net operating income would be $128, which is about the closest you're going to get because of that 1138. Okay, so that's the closest that you can get. That's what we're looking for, is where do we eventually hit a small profit? You know, maybe not a full one, but a small one. Okay. So then we're going to go and look at our contribution margin analysis, right? And so we take our 3,000 units that we started with times the 1,500. We're taking those same numbers, right? And looking at our variable cost as well. And getting 3.4 million. So our contribution margin, when you subtract those two out, is just over $1 million. Take out our fixed cost, we get our not operating income, a net operating income of 491. Okay, so that's our operating income. And then we take our contribution margin ratio, okay, which is the ratio of contribution margin to sales. So basically, you're going to take your contribution margin, divide it by your sales. That gives you your ratio or your per unit amounts. Same thing. Okay. So for this example, we would take the 1,086, remember that's our contribution margin right here, divided by our 4.5 million in sales. So our ratio is 0.24 rounded, okay, of course, okay. Our 362 divided by, this is on the per unit basis, right? So this is coming back all the way back up here, this 362, okay, divided by our 1,500, and we get the same 0.24 rounded. Make sense? Then there's some alternate formulas as well that you can work in order to get that. But these are your step-by-step instructions of how to complete problem 6-6A. You have to follow these step by step, okay? So if we go in and we look at your problems, let's just walk down through this. I'm going to have to turn my phone and my iPad off. People are bugging me today. 6-4A is our first problem. So this is that high-low cost formula. So let's talk about that. Okay, it gives you your high and lows. So I encourage you to go in and set this up to take a look at it in your own way. So you've got to get your total mix cost isolated. Okay, so we have to find our total cost, which is what? the 468,000, right, at 80,000. And on our high side, it's 604,000. Okay? So then we're going to subtract out our variable costs. Okay, so on the high side, our variable cost, because it says here, total costs includes variable, fixed, and mixed at 120,000 direct labor hours. The total cost breakdown is as follows. So this gives you the 120,000. This is like solving a puzzle, guys. Okay, so this gives you the 120,000 level, which is this side, right? So this is your high side. So your variable cost on this side is the 264,000, which means you've got, and your fixed cost is 160,000, and your mixed cost is 180. Okay, so that solves down your 120,000 level, right? So we've got this side. This is what we've been given. Now we have to figure out this side. So we have to figure out these numbers for the low side. And in order to do that, we're going to take our variable cost divided by our direct labor hours to get our rate. Once we get that rate, we can figure out what these numbers are right here. Okay? Because all we're going to do at that point is take our rate times the 80,000 hours, right? So basically, that's going to say for the low, okay, you're going to get that 80,000 times, let's see, 80,000 times answer, yes. So our variable cost is going to be the 80,000 times the rate that we get, okay? And then, of course, your fixed cost, what is fixed? Fixed is always the same, right? So we know that answer already. So you could actually also take that and figure out what your total mixed cost is because you've already got your total cost, right? So you basically are going to solve this puzzle, so to speak, for these three numbers. We know fixed cost is going to be the same as fixed cost. So you can work this down and figure it out, right? Then the next part of it, you're going to figure out your variable portion per unit. So you're going to take that variable portion per unit, you know, after doing your high and your lows. So remember, you've got to take the 120 minus the 80, right? And you've got to take the 180 minus whatever this is. Okay, so that's why it's important to figure these three numbers out first. Then you're going to take that 180 minus that, right? And you're going to do the apparent variable portion per unit by dividing those two numbers out that you find the two differences, divide those two numbers out, and that's going to give you your rate per direct labor hour. Okay, so that's A. That's what this is. That's what that's asking. Make sense? Then B says, what should the total planned overhead cost be at 100,000 direct labor hours? So once you've got those two components of A figured out, you can come in here and say, okay, my variable unit cost is X. I know my total fixed cost is always going to be 160,000. What is my variable portion? So you can see part A for that as well. And what is my fixed portion? You'll see A for that as well. You can add those two up, get your total costs, and then your total planned overhead at 100,000 direct labor hours. You basically plug those totals, the total unit cost and the total cost, into total fixed cost into that formula, and you're going to take 100,000 times the unit cost rate plus the total cost, and that's going to give you your final answer for number 1. Okay, so try working that out. Again, it follows step by step the book to what you've been shown in your example. Okay, just have to read back through it. Okay, and then 6-6A is going to be very similar. You're going to find your contribution margin ratio, and your break-even. You're going to do your break-even analysis. Okay, so A will be, your I don't know why this is sitting where it is. A will be, what you figure out to be your contribution margin. Then B, you're going to do your total fixed cost divided by your unit contribution margin, which is going to equal your break-even units. And then C, you're going to do the total fixed cost divided by the desired net income before income tax. So that's the desired net income is this 39.6 that they give you, right? And divided by your unit contribution margin, and that's going to give you your number of units. D, you're going to get the desired sales, okay, by taking your total variable cost plus your total fixed cost plus your desired net income before income tax. Okay, so you get your desired sales times the number of units, plus, which is equal to whatever that rate is, times the number of units plus your total fixed cost. So you have to use the formula to figure those out. Okay, and you're going to use your 20% in that formula. Okay. On E, same thing. You're going to use the same formula as what you did in D to recalculate, based on these numbers, an after-tax income of 43.2 times a tax rate of 40%. Okay, so D and E are basically just the last two parts. All right, pretty straightforward. Guys have any questions?
I think I'm good.
Okay. It's literally just following these formulas that are here in your book, for the contribution analysis, or the break-even and the contribution margin analysis, and then, of course, using your high-low method on page 203. Okay. So those are going to be really important to you to make sure. Obviously, you have to understand, the plotting and stuff like that, but hopefully this review kind of helps you with that and kind of walks you down through the steps that you have to take. Okay?
Yep, thanks.
All right, guys. Any other questions? Awesome. All right, you guys have a fantastic week. Don't forget to watch your midterms, and you can start correcting. Those midterm corrections are due by Thursday at 11:59 p.m. next week. So that is the week of, let's see what the date is. I'll give you the exact date here. That is Thursday the 26th, and I'll post an announcement about that as well. Thursday the 26th by 11:59 p.m. Your midterm corrections will be due. I will have all of your grading done by Thursday. Sound good?
Awesome. Thank you.
All righty. Thanks, guys. Have a great week. Talk to you later.
Bye.
Bye.
Huh?